Norm owns a rocket company. He didn't buy one. He didn't click anything. Nobody called. One Thursday in June, a rule changed in a building he has never been in, and a very small piece of the biggest IPO in human history was folded into his retirement account, somewhere between a soda company and a regional bank. Snake oil normally has to be sold. Someone plays the music, someone pours. This bottle shipped itself. That's new. Let's take it apart. Start with the launch. In June, SpaceX listed on the Nasdaq under the ticker SPCX at $135 a share, a valuation of about $1.75 trillion. It raised over $75 billion, which made it the largest stock market debut ever. The old record was Saudi Aramco at $29 billion. SpaceX didn't break the record. It doubled it, and then kept going. And this offering came with an unusual door. A typical mega IPO hands 5, maybe 10% of the shares to ordinary investors. SpaceX set aside roughly 30%, about $22.5 billion worth, available through 5 retail brokerage apps. Demand reportedly hit $150 billion, twice the shares that existed. For a company that lost $4.3 billion on its books in the most recent quarter, Norm could have bought some. Here's the thing. He didn't. Remember that. It's the detail this episode turns on. Day one went the way day one goes. Priced at $135, opened at $150, closed at $161. Up 19%, worth about $2.1 trillion by dinner. The 6th most valuable company in America on its first afternoon as a public company. Now, between a hot stock and your retirement account, there has always been a fence. The big indexes, the list that retirement money automatically follows, had rules. Show up on the market and behave for a year. Show a profit. Have enough shares actually trading that the price means something. Boring rules. Fence rules. They existed because the people most excited on day one are historically not the people you want picking what goes in the nation's 401ks. SpaceX cleared none of them. Not the year of seasoning, it was 3 weeks old. Not the profits, see above. Not the float, only 3 to 5% of the company actually trades. And here, the story turns. The rocket didn't change to fit the rules. The rules changed to fit the rocket. On May 1st, the Nasdaq rewrote its methodology. Any new listing in the top 40 by size can join the Nasdaq 100 after 15 trading days. The minimum float requirement wasn't reduced, it was eliminated. The fence got removed, specifically where the rocket was going to land. And it wasn't just one index. FTSE Russell brought in a 5-day fast lane. CRSP, the index behind the biggest total market funds in the country, has one too. Committees that had asked every company for a year of patience since basically forever all discovered in the same spring that patience was optional. Funny timing. So follow the dollar. June 18th, 5 trading days after the debut, SpaceX entered the total market index, which means the total market fund, which means the target date fund sitting inside millions of retirement accounts. That Thursday, an enormous number of Americans became rocket shareholders between breakfast and lunch. No notification, no checkout screen. The fund did what the label says it does. It bought the market. The market had just been edited. July 7th, the bigger valve opened. SpaceX joined the Nasdaq 100. Every fund tracking that index, hundreds of billions of dollars worth, was now contractually obliged to own it. More than $4 billion of buying before the market opened, executed by machines with no opinions about the price. Paid for with small trims of everything else. A little Apple sold, a little Microsoft, a little Nvidia. Nobody was kicked out to make room. The Nasdaq 100 has more than 100 companies in it now. Nobody's in a rush to fix the name. Then, the part nobody predicted. One committee said no. The S&P 500 had opened its own consultation about a fast lane. On June 4th, it rejected its own proposal. The rules stand. 12 months on the market, 4 straight quarters of profits, or you wait. SpaceX does not enter the S&P 500 until the middle of next year at the earliest. and only if the rocket company does something it has not yet done, which is make money. One index read its own label. Hold that thought.
Here's where our salesman usually earns his fee. Watch him this time. The room is empty. He plays anyway, to nobody, and the money files in on its own, single file, on a schedule published in a methodology document. He doesn't pitch. He doesn't pour. He checks his pocket watch. The bottle says pre-IPO rocket juice, and it's already in your cupboard, because your grocery list is written by a committee now. The pitch nobody had to make. So with $4 billion of automatic buying arriving on a published date, the stock did what? It went down. The peak had already happened, $225 and change, in the post-listing glow when the company was briefly worth more than Amazon. The buyers everyone could see coming had been front-run by the buyers you never see. The stock fell almost 7% the day the index money arrived, about a third below its high. When everybody knows the crowd shows up Tuesday, the smart money shows up Monday and leaves Tuesday. There's precedent, and it's tidy. Tesla, 2020, ran up about 70% into its index inclusion, then went sideways for weeks while the early money walked out. Palantir, 2024, peaked right around inclusion, down a quarter in the weeks after. The pattern isn't a scandal, it's a schedule. Guaranteed buying, announced in advance, is a gift, just not to the person doing the guaranteed buy. Who got paid? The company. $75 billion at 90 times revenue, no profits required. The early holders, who finally had someone contractually required to buy from them. The exchanges and the brokers, paid per trade, both directions. And the front runners, who bought before the machines and sold to the machines. Everyone on that list chose to be there. Who paid? Whoever bought the glow at 200 plus, chasing a chart. And, in very small print, every index investor, whose funds sold slivers of profitable companies to buy a sliver of an unprofitable one, at whatever the price happened to be that day. Not because anyone decided it was a good deal, because the list said so, and the fund's one job is to match the list. Which brings us back to Norm's statement. His actual exposure per $10,000 in a total market fund, about $17. 17. Norm is fine. The float is so thin the machines could only push a few dollars through the door. The precedent isn't $17. The precedent is the plumbing. The biggest IPO in history got piped into the nation's retirement accounts in 5 trading days, without a single retail buyer clicking a single button. And the next ones, reportedly OpenAI, Anthropic, the pipe is already installed. Nothing here was hidden. Every rule change had a press release. No one lied to Norm. Nobody had to. The old snake oil needed Norm to hear the song and reach for his wallet. 3 chances to say no. The new snake oil is in the water supply. The dose is small. The choices are gone. An index fund is still the best deal in investing, but the label says the market, and someone else just quietly decided what the market means. Nobody asked you. That was the product. Snake oil finance. Read the label. Even the ones that say everything. There's a new bottle every week. Subscribe if you'd like to know what's in it before it's in your cupboard.